Good evening, Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you on this evening of the 17th of December, 2024. Year-end review, December 2024 market conditions report. So I very much appreciate your attention. We'll try to run through these slides. There's a lot of them here. We'll try to run through them effectively and efficiently to get you fully briefed on how we're seeing things in the market, in the economy, etc. So with no further ado, I will share my screen and move forward. So here we go. So the next slide, here we go. The macro backdrop. Okay, we've talked about this a number of times over the course of the last several months. This notion that the historical evidence is pretty accurate and convincing that there is likely to be a second wave of inflation. Since the 1960s, whenever we've seen or witnessed a inflationary period where we're seeing at least 6%, which we did 2 years ago, 90% likelihood of a second wave of inflation. So this is what the market is not really anticipating, but is fairly likely. Three more secular reasons, each of them starting with the letter D, that suggest to us that perhaps inflation is indeed stickier. And to that end, the 10-year bond and interest rates are less likely to come down precipitously. The Fed might cut. That doesn't mean that the 10-year bond or the market participants will see that we're moving to a low interest rate environment. It very well may be the opposite, where bond vigilantes come back and they want a higher return for their investment. The three Ds. Number one, deglobalization. Clearly inflationary, a lot more expensive to produce goods in this country than abroad. We're not really getting along with a lot of other countries. So therefore, the deglobalization trade is real and impactful on an inflationary front. Number two, decarbonization. Clearly, the world is moving to a decarbonized world. And with that comes cost pressures as we haven't invested in the supply of needed materials like copper and aluminum and green metals. Third D, deficit spending. I would throw debt into there. Those are inflationary, especially the huge amount of debt we have. Here is that debt. As you could see, it is on a historical high versus GDP and likely projected to go higher. But this slide that speaks to the cost of that debt, the servicing, now almost $1 trillion, folks, to service our debt, and interest rates are not to a point where it's going to be very different going forward. So as the cheaper or older bonds mature and they have to refinance, those refinance rates are higher, and so this is why we see some challenges to the economy dealing with this idea of servicing our debt. So market internals for you to digest. These are observations. We'll start with the rule. One first rule of investing is diversification. This is an interesting slide that's going to talk about the lost decade, 2000 to 2010, when the S&P 500 was essentially flat. And what did well? Things that didn't do well for years prior. And so you have the emerging markets in this case. So, and what did poorly? What did very well the prior 10 years, right? So it's this idea that you want to be putting capital to work in all areas. You want to tweak that allocation to the asset class that's the cheapest, for they will more likely than not revalue over time. This concept Very powerful concept in finance for reversion to the mean. So that's what we're seeing here. And we'll see that in a moment as well. There's some concentration risk in this market, folks. The yellow flashing light of caution here. Top 10 stocks in the S&P are now 36%. That's the highest ever. 10 stocks out of 500, 36%. Let that sink in. Let that sink in. Lest you think this is normal, it is not. This is a concentrated market, and to that end, there's heightened risks associated with that concentration. The second slide speaks of the top 10% of the stocks. The biggest stocks are essentially 75% or so of the market. Again, as you can see the previous peak here in red. These are important flashpoints. This is another yellow light. Everyone's bullish. Everyone's loving stocks. What do you expect after a year like this? So you see here, this is the people that are saying that stocks will rise. Optimism, optimism. And here we have a graph that shows how the amount of folks that are in household allocation to equities have never been this amount, this much. So these things worry guys like us. But the most important factor for investment success over a market cycle, not short term. Short term is noise. Short term could be momentum, could be whatever data point is hot for the day, a week, the month. But in the longer term, as investors, we seek longer term investments. We're not traders. We're not gamblers. That's not what we do. We're wealth managers, serious stuff. Well, the most important factor shown and documented in many academic journals and research, the most important factor is what you pay when you enter the investment. Price matters. Very important concept. So sometimes people say, oh, the market's running, but everything's already inflated. And so, by making that jump, that leap of faith, you're hoping that there's someone else out there that will buy your inflated security at even a higher price. That's sort of the definition of a bubble. So let's be sensitive to price. And when we look at that and we look at valuation, we've got some sobering statistics. This is forward price to earnings ratios. Forward 22.3 times. That's looking at next year's earnings versus today's prices. This is one of the highest ever. 1999 was a little higher. Next, we got price forward PEs versus their 25-year average. No, look at this, guys. In every circumstance, maybe except for energy, but every other circumstance, the current forward PE is, I would say, even substantially higher than their 25-year average. This is an important data point. Price to sales multiple. This is the looking at the price of the security versus the sales, the top line, rather than earnings. And here again, you see we're in rarefied air here, guys. Rarefied air. This is worrisome because price to sales is really a metric that's used mostly for, the sort of highest multiple growth stocks. And you could see here, there's lots of them apparently. So this is concerning. By the way, at 10 times sales, as the former CEO of Sun Microsystems had said in 2000 to analysts, what were you thinking? It's very hard to make the math work at a 10x sales ratio. CAPE, this is our friend Robert Shiller from Yale, Nobel laureate, who came out with a cyclically adjusted PE ratio, smoothing out earnings over a 10-year period. And you can see here, despite that smoothing, we are still quite high on the CAPE. This is a slide I threw in from our friends at Goldman Sachs, and it looks at the cyclicals versus the defensive. So if the cyclicals are doing well, because you can see the graphs going up, so the cyclicals are doing well versus the defensives, which pretty much means no one's worried, right? That's that the economy is going to do well. That's why cyclicals are doing well, and no one needs defensive sectors because no one's worried. Okay, fair. We'll see. Speaking of hopes and dreams and expectations, this is a cool graph from the folks at Bloomberg. They call it the Hope and Dream Index. And what it's showing, it's a new high. It's 68% of the S&P is unexplained, not explained by book value or earnings or net present value. In other words, there's no fundamental reason that, or the majority is not a fundamental reason for stocks to be going higher. So what else is there? Well, it's the madness of crowds. You know, Buffett always says, or has said, that in the short term, the stock market is like a popularity contest or a voting machine, right? Where individual participants make a difference. And that's what the short term is. However, over the longer term, as investors, we look at the longer term, the market cycle. Over the longer term, the market is more like a weighing machine where empirical, definitive evidence is the determinant of value, not the short-term noise. So this is what we look at. We look at the longer term and we look at the actual numbers, not the hopes and dreams. We see opportunities, perhaps those that are maybe under the radar or in different spots than others, but we do find opportunities. That's what we do every day. We scour the investment landscape to find those opportunities with a margin of safety where we can provide strong upside to our clients without a big downside risk. American exceptionalism. Remember the graph from earlier on when we talked about diversification and how you have to have in different spots over time? Well, since 2008, it's been USA all the way. I get it. I drink at the same font of American exceptionalism as you do. But when it comes to numbers and when it comes to investments, we have to try to divorce ourselves from the emotions and look at the actual numbers, do the work, do the analytics, look at the figures. They don't lie. And when you look at those figures for US versus the world, ex-US, is a gulf of a huge delta between the valuation. This is forward PE, right? Looking at next year's earnings versus the current price. Look at the S&P versus where the MSCI World ex-US is. I mean, it is huge. And frankly, we didn't see much of the, you don't see this kind of gap ever before. We've seen a little bit here, and you can see what happened since then. But this is a massive differential between PEs. And I worry that maybe the American exceptionalism trade has gotten too long in the tooth. We'll see. But I will say, I am finding some interesting opportunities outside the US. Great companies, 150-year-old, family-owned, that kind of thing. Dividends, strong assets, good cash flow, cheap on a valuation level. Does not mean they will do well quickly or short term. Just means you're buying them right, and price matters. This is a slide that shows the same thing. Look how depressed over the last 15 years the international markets have been. And these are not small companies. These are the biggest companies outside the US. In this case, Europe and the Far East. I mean, folks, this is probably an opportunity. Another opportunity we like to think about is thematically, right? We look at thematics. You know, our penchant for the water sector over the years, cybersecurity, most recently, data electrification, the build out of the grid, getting ready for electrification is another big theme of ours. And please contact us to learn more about these model portfolios that we run based on these themes. Okay, so why electrification? Well, the first thing is demand. Demand is going to be huge for energy. As you can see in this slide, we're looking like we're adding three New York cities to the power grid by 2030. New York City's power grid's huge, three of them in 6 years. It's a lot of demand. Here's another one that speaks to global spending on cloud services, on data center construction. They all need HVAC. They all need water. They need, obviously, electricity, perhaps cybersecurity as well. So these are the ideas that come from these bigger themes that we can invest in without paying at a high multiple for. Global electricity demand consumption, global electricity consumption from data centers. Look at that huge 117% growth. We're only talking a couple of years away. So big stuff. And this is, and AI is only getting bigger, right? So there'll be more demand. I want to leave with this. Markets have been good. 2024 and on the heels of 23, 2 great years after the difficulties of 2022. But it's important, folks, to review your portfolio, to understand where you're positioned, to understand the thesis behind those positioning, what themes, what sectors, the allocation, your financial plan, how it interfaces, your estate plan, if that's involved as well. So these are the things that we do in our second opinion service. No cost, no obligation, an opportunity for you to test drive the folks at ALINE, for us to give you a sense on how we are thinking about your portfolio and your plan. If there's a fit, we welcome the engagement. If there isn't, we'll part as friends and we go forward. I think you'll come out with something from this discussion that will be fruitful for discussion, so it's worthwhile. It's an excellent way to take a look at your current financial position and to retake a second opinion on your financial plan. So we're happy to do that with you, and we would welcome the opportunity to do so. So thank you for your attention. We certainly appreciate it. I want to thank you for, again, your vote of confidence over the year and your loyalty to ALINE Wealth. We're here to serve. You feel free to contact us at alinewealth.com. You can go to our website and see our blog posts and see different videos that we do. We're here to serve. Have a great holiday season and Happy New Year.